Welcome to the Deep Dive, where we take your sources and unpack the most important nuggets of knowledge. Today we're diving into something pretty fascinating, maybe even a bit of a paradox. You hear Warren Buffett, right, the ultimate value investor, talk about derivatives. He famously called them financial weapons of mass destruction.
Right, that quote gets thrown around a lot.
Exactly. But here's the twist. He actually uses options. And not just tinkering around the edges, he uses them strategically in a way that's, well, frankly, a masterclass in disciplined investing.
Yeah, it's a side of Buffett that maybe doesn't get as much attention, but it's deeply connected to his core philosophy.
So that's our mission today. We want to explore how the Oracle of Omaha actually employs these tools. We'll look at his foundational thinking, his main option strategy, dive into some real-world examples, and even how he used them during the 2008 crisis. You might think options are just for, the fast traders, the speculators, but Buffett's way is completely different. It's about discipline, about getting paid for patience, spotting when the market gets things wrong.
It really turns the common perception of options on its head.
Okay, so let's unpack this. Before we even get to the options themselves, we absolutely need to understand the bedrock, the foundation, which is Buffett's core value investing principle.
Definitely. It all comes from Benjamin Graham, doesn't it? That school of thought.
Yeah, seeing a stock not just as a ticker flashing on a screen, but as owning a piece of a real business, a living, breathing company.
And what's really interesting there is that his use of options, it isn't some kind of deviation from that. It's not like he suddenly became a trader.
Right.
It's more like an extension, using specialized tools to apply his value strategy with maybe more precision. So the question becomes, what actually defines a worthy investment for Buffett? What are the key things he looks for?
Okay, yeah. What are those pillars?
Well, first up is company performance, specifically return on equity, ROE. He wants to see consistently high ROE. Over a good stretch, like 5-10 years.
So proof that management is actually good at making money with the shareholders' money.
Exactly. It shows efficiency. Then there's debt. He really prefers low debt. He looks closely at the debt-to-equity ratio, the DE ratio. He wants companies that fund their growth from their own earnings, not by loading up on leverage.
Financial strength, self-sufficiency. Makes sense.
Precisely. And along with that, profit margins. Are they high? Are they stable? Or even better, increasing over time? This tells him about the company's efficiency, its competitive edge, its pricing power.
Can they dictate terms, or are they getting squeezed?
Right. And finally, the big one, durability and simplicity, the moat. He loves businesses that are easy to understand, predictable, and have proven themselves over time, say 10 years or more as a public company. They need that durable competitive advantage.
Like a strong brand, think Coca-Cola, or maybe low-cost production, something that protects them.
Exactly, a moat.
So it's clearly not just about crunching the numbers, is it? There's a huge psychological element here, too. I mean, his famous line, be fearful when others are greedy, and greedy when others are fearful.
Oh, absolutely. Emotional discipline, patience. These aren't just nice-to-haves for Buffett. They're fundamental. They're critical.
Okay.
And this is where options become such a powerful tool for him. It's not about speculation. It's actually a mechanism to enforce that discipline.
How so?
Well, it turns a thought like, I'd love to buy that great company if it ever hits price X, into something concrete, a binding contractual obligation.
Yeah.
It forces your hand in a disciplined way, takes the emotion out of it when the time comes.
Ah, I see. It makes your intention real. Okay, so with that value foundation laid, how does he actually do it? What's the main option strategy he uses? This is where it gets really practical.
Yeah, the most common one we see him use is selling cash-secured put options.
Okay, sounds a bit technical. Break that down.
It does sound technical, but the core idea is simple. It's about getting paid for your patience, monetizing patience.
Getting paid to wait. How?
Okay, so when you sell a put option, someone pays you money right now. That's called a premium.
Okay, cash up front. I like that.
Right. In exchange for that cash, you agree to do something. You agree to buy 100 shares of a specific stock at a specific price. That's the strike price. If the stock price falls below that strike price by a certain date, the expiration date.
And cash secured, what does that part mean?
That's crucial. It means you actually have the cash sitting there, ready, earmarked, to buy those 100 shares at the strike price if you have to. You're not using borrowed money, no leverage. You can fulfill the promise.
Got it. So you're making a commitment to buy a stock you already decided you like at a price you already decided is good, and you have the money ready.
Precisely. And you get paid up front just for making that commitment.
Okay, so what happens then? What are the outcomes?
For a value investor like Buffett, there are basically two good outcomes. Scenario one, the stock price stays above your strike price until expiration.
So it never gets cheap enough for the buyer to want to sell it to you at the strike price.
Exactly.
Yeah.
The option expires worthless. The buyer doesn't exercise it. And you just keep the entire premium you collected up front. Pure profit. You got paid for being willing to buy.
Paid for patience, literally. Okay, what's scenario two?
Scenario two. The stock price does fall below the strike price by expiration. The buyer exercises the option.
So you have to buy the shares.
Yes, you buy the 100 shares at the strike price you agreed on, the price you already determined was attractive. But here's the kicker.
There's more.
Your actual cost, your effective cost basis, is lower than that strike price because you subtract the premium you received per share from the strike price.
Oh, right, because you already got paid that premium. So strike price minus premium equals your real cost.
Exactly. Effective cost basis, strike price premium received per share.
Wow.
Right.
So either outcome is good. You either make money for doing nothing but being patient, or you buy a company you wanted anyway at an even better price than you initially targeted.
It's a win-win for a disciplined value investor. It fits perfectly.
It really does seem like a way to put your money where your mouth is regarding buy prices.
It is. And, while he doesn't really talk about it in these terms, his actions often mirror the first step or two of what some people call the wheel strategy.
The wheel. What's that?
It's basically, step one, sell cash-secured puts on a stock you want to own at a good price, just like Buffett does. Step two, if you get assigned the shares, you now own them at a good cost basis. Step three, which is optional and part of the full wheel, is then selling covered call options against those shares you own to generate more income.
Okay, so selling puts is the entry strategy.
Right. For Buffett, the focus seems primarily on that disciplined entry. That's step one. It fundamentally changes your relationship with the market. You're not just reacting to prices. You're setting your terms and getting paid for it. You're essentially selling price insurance.
Selling price insurance. I like that framing. Okay, let's make this concrete. You mentioned Coca-Cola earlier. Can we walk through that specific trade from 1993? That's a classic example, isn't it?
It really is a perfect illustration. So back in 1993, Berkshire Hathaway already owned a lot of Coke stock. It was, a textbook Buffett company. Quintessential.
The ultimate moat business.
Totally. But even with a company he loved that much, he wasn't going to just buy more at any price. He was patient. He waited for his price.
So what was the setup?
Okay, the trade happened in April 1993. Coca-Cola stock was trading around $39 a share at the time.
Okay.
Buffett decided that $35 per share was a much more attractive price for him to add more. That was his target.
So below the market price.
Right. So he sold put options with a $35 strike price. For selling these puts, he received a premium of $1.50 per share.
$1.50 per share, just for agreeing to buy at $35 if it dropped.
Exactly. And he did this on a large scale, 50,000 contracts. Since each contract represents 100 shares, that was a commitment to potentially buy 5 million shares.
Wow, and the total premium?
$1.50 per share times 5 million shares, that's $7.5 million, collected up front. Cash in the bank for Berkshire, non-refundable.
$7.5 million just for being willing to buy Coke at $35. And when did these options expire?
They had an expiration date in December 1993, so about 8 months later.
Okay, so what happened? Did Coke drop below $35?
It didn't. The stock price actually stayed above $35 the whole time, mostly trading between $40 and $45. So the options expired worthless. Nobody exercised their right to sell him shares at $35 because the market price was higher.
And Berkshire just kept the $7.5 million.
Kept the entire $7.5 million, free and clear. That's the paid-for patience outcome.
And if the stock had dropped below $35, say to $34...
That he would have been obligated to buy the 5 million shares at $35. But remember that premium.
Right. His effective cost would have been $35 minus the $1.50 premium, so $33.50 per share.
Precisely. An even better price than his initial target of $35. So either way, it aligned perfectly with his value approach, a win.
That's a fantastic illustration. Okay, so that's individual stocks. But you mentioned he took this options idea even further, connecting it somehow to Berkshire's core insurance business. That sounds like a whole different level.
It absolutely was.
Yeah.
This is where it gets really grand in scale and ties into the concept of insurance float.
Float being the premiums collected that haven't been paid out yet, which Berkshire invests.
Exactly. That massive pool of capital insurers get to invest for their own benefit before paying claims. Buffett realized he could, in effect, create a similar kind of float using derivatives, specifically by selling very, very long-term put options.
How did that work? What was he selling puts on?
This time, not individual companies. He was selling puts on major global stock market indices. Think the S&P 500 in the US, the FTSE 100 in the UK, the Euro Stoxx 50, the Nikkei 225 in Japan.
Wow. So essentially betting on the long-term health of entire economies.
That's exactly it. A bet on the long-term productive capacity of the world's major economies. This was mainly happening between, say, 2004 and 2008.
And the scale. You said grand.
Astronomical. The total face value, the notional value of these contracts, was around $37.1 billion.
Billion, with a B.
With a B. And for selling these long-term puts, Berkshire collected about $4.9 billion in premiums. Upfront cash, immediately investable. That $4.9 billion was the float, analogous to insurance float.
Almost $5 billion in investable cash, generated from selling options. What made these deals special?
Several things. First, the time horizon. These weren't short-term options. They had expirations 15 to 20 years out. We're talking expirations from 2019 all the way out to 2028.
15 to 20 years, that maximizes the time he gets to invest the float.
Exactly. Second, they were European-style options.
You mentioned that. What does that mean again?
It means they can only be exercised on the final expiration date, not before. This was absolutely critical. It meant that even if markets crashed temporarily, like in 2008, Berkshire couldn't be forced to pay out early. They could just hold on.
Ah, protection against panic selling or forced settlements.
Huge. And maybe the most important part, no collateral posting required.
What? How? Normally with derivatives, you have to post collateral, right? Margin calls?
Normally, yes. But because it was Berkshire Hathaway, with its fortress balance sheet and AAA credit rating, Buffett was able to negotiate deals where they didn't have to post collateral, even if the market moved sharply against their position on paper.
That's incredible. That removes a massive risk that destroys other derivatives players, the liquidity crunch from margin calls.
Completely. It insulated them. So he wasn't just trading options here. He was using derivatives as a sophisticated corporate finance tool to raise billions in very cheap, very long-term capital.
That reframes the whole financial weapons of mass destruction thing, doesn't it? Because this brings us right to that apparent paradox. He's calling them WMDs, yet Berkshire has billions riding on them, especially heading into and during the 2008 crisis. How does he square that circle?
It seems contradictory, but it really isn't when you look closely. His criticism wasn't about the existence of derivatives. It was about how they were typically used.
Okay, what was wrong with how others used them, in his view?
The leverage, often hidden. The complexity, making them impossible to understand. The lack of transparency. And crucially, the counterparty risk, who's on the other side. And the collateral risk, those margin calls we just talked about.
Right, the things that blew up firms like AIG and Lehman Brothers.
Exactly. Now look at how Buffett structured his deals. He sold options, collecting cash, using zero leverage himself. His contracts were relatively simple index puts. He was the strong counterparty. And critically, no collateral posting. He systematically eliminated every single one of the dangers he warned about.
So he was criticizing the irresponsible use, not the instrument itself when used responsibly.
Precisely. He was acting like the house, the insurer, not the gambler. And there was another layer to this. His intellectual disagreement with how the market priced these things.
What do you mean?
He fundamentally disagreed with the standard pricing model, Black-Scholes, especially for these very long-dated options. He thought its results were, and I quote, wildly inappropriate and absurd for horizons stretching decades out.
Why? What was wrong with Black-Scholes in his view?
He argued its heavy reliance on historical volatility, how much the market bounced around in the past, was simply irrelevant for predicting outcomes 20, 30, or even 100 years into the future for broad market indices.
Because long-term growth, inflation, reinvestment, those factors dominate over decades, not short-term wiggles.
Exactly. He did this thought experiment. Black-Scholes might say, a 100-year put option protecting $1 billion of the S&P 500 should only cost maybe $2.5 million in premium. Buffett thought that was utterly ludicrous.
He thought the market was drastically underestimating the potential for long-term upside and therefore overpricing the long-term puts.
Yes. He believed the market was systematically charging too much for this long-term insurance, creating a massive opportunity for him to be the seller, to collect those overpriced premiums.
So he saw a market inefficiency driven by flawed models. Okay, then 2008 happens, market crashes. What happened to Berkshire's big options position?
Well, on paper, it looked bad for a while. As markets plunged, the mark-to-market value of these puts went deeply negative. At one point, Berkshire reported a paper liability of around $10 billion on these contracts, meaning an unrealized loss of about $5.1 billion after accounting for the premiums they'd collected.
A $5 billion paper loss, that must have caused some nervousness.
Maybe elsewhere, but remember, Buffett's structure.
Right.
Long-dated, European style, no collateral calls. These were paper losses only. Berkshire wasn't forced to sell anything. They weren't facing a liquidity crisis because of these options. They just held the $4.9 billion in cash they'd collected and waited.
They could afford to wait because of the terms he'd negotiated.
Exactly. Time was on their side. And as we know, markets eventually recovered. The contract started expiring from 2019 onwards.
And the final result.
By 2019, Berkshire had actually recorded a pre-tax gain of $1.5 billion on this portfolio. The final payouts as contracts expired turned out to be, in their words, relatively insignificant by 2020. His contrarian assessment of the pricing, his patience, his structural advantages, it all paid off. He was vindicated.
That's an incredible story. So bringing it all together, what are the key takeaways for, the prudent investor listening to this? Buffett's use of options is quite specific, maybe not for everyone, but what are the powerful lessons?
I think the biggest thing is seeing how options, when used with extreme discipline and deep understanding, can actually support a conservative long-term value philosophy. They aren't necessarily antithetical to it.
How do they support it?
Well, first, disciplined acquisition. Selling cash secure forces you to buy only at prices you've already decided are attractive. It imposes discipline.
Takes the emotion out of market dips.
Right. Second, income generation. It literally monetizes patience. You get paid while you wait for your price. Third, on that grander scale, capital formation. A way to raise low-cost, long-term funds if you have the credibility. And fourth, exploiting mispricing. Capitalizing when you think the market, perhaps due to flawed models or short-term focus, is getting the odds wrong, especially on long-term risk.
It really comes down to that distinction you made earlier, acting as the house versus acting as the gambler.
That's the core of it, I think. Most retail option activity is buying options. Low probability, high payoff bets, often leveraged, where the premium paid is usually lost. That's being the gambler.
Hoping for a lottery ticket payout.
Yeah. Buffett sells the options. He's the casino, the insurer. He collects the premiums. He carefully calculates the risk, operates from a position of immense strength, cash secured, no leverage, favorable terms, and profits from others' desire for price protection or their speculative bets. He took these potential weapons of mass destruction and turned them into tools for methodical, disciplined value creation.
So today we've really unpacked Warren Buffett's surprising but actually very logical use of options. We saw it's grounded in his core value investing. We looked at cash-secured puts with Coca-Cola, generating income or getting a better entry price.
Right, the win-win setup.
And then the huge-scale index puts, creating billions in insurance-like float, navigating 2008 because of smart structuring and challenging standard pricing models.
Showing his WMD warning was about reckless use, not the tools themselves.
Exactly. So as you listen to this, what stands out? Maybe it's just that simple idea that you can get paid for being patient, or that really understanding a business's value lets you see market risk differently, maybe even as an opportunity. It makes you think, how would shifting your mindset from being the gambler to being more like the house, even in small ways, change how you approach investing and managing risk? Something to ponder.
Definitely food for thought.
We hope this deep dive gave you some new insights into Buffett's strategies and maybe a different angle on options. Thanks for joining us on the Deep Dive.